Private credit is generating more conversation than ever, but for disciplined investors, the important question isn't whether it's popular. It's whether it belongs in your portfolio. When a newer investment approach becomes popular, it's worth asking what truly sets it apart from the legacy options investors have relied on for years. In this case, how different is private credit from public credit? At 1900 Wealth Management, our team of advisors helps clients evaluate opportunities across both public and private markets. Private credit is one area that has generated significant interest, and understanding how it fits within a broader portfolio is worth exploring. At their core, both public and private credit involve the same fundamental concept. Investors are lending money to a borrower in exchange for interest payments and the expectation that principal will be repaid at maturity. Whether that loan exists in a publicly traded bond, a business development company, or a private lending strategy, the underlying economics are often more similar than many investors realize. That's where the phrase, "lending is lending," comes from. So why are investors paying closer attention to private credit now? The reason is the search for income. As interest rates and market conditions have evolved, investors have increasingly explored alternative sources of yield beyond traditional bonds. Private credit has become part of that conversation, particularly among investors willing to accept certain trade-offs in exchange for potentially elevated income opportunities. Another factor is the way private investments are valued and experienced by investors. Public credit investments are priced every day. Those prices can fluctuate based on interest rates, economic expectations, market sentiment, and investment behavior. Private credit investments typically are not traded on public exchanges each day, which means investors may experience less visible day-to-day price movement. However, less visible volatility does not eliminate risk. At 1900 Wealth, we evaluate private credit with the same discipline applied to any lending investment. Credit quality matters, borrowers may default, and manager selection remains important. Liquidity is another key difference. Public credit generally offers daily liquidity, while private credit often requires a longer investment horizon and reduced access to your invested funds. Neither structure is inherently better than the other. The more important question is whether the investment is serving the intended purpose within your portfolio overall. Private credit should be evaluated within the context of your long-term goals, liquidity needs, income needs, and most critically, your individual risk tolerance. Because successful investing isn't about chasing the newest opportunity, it's about making sure every part of your portfolio is working toward a long-term plan. If you would like to discuss how private credit may fit within your overall strategy, our team is ready to help. Call us at 210-736-7770 or visit 1900wealth.com.